Welcome, everyone. Today, we're here to talk about Magnifi by Tiffin, a marketplace where you can harness real-time proprietary data to help individual investors and financial advisors find, compare, and buy investment products like stocks and ETFs and mutual funds and model portfolios to grow and preserve your wealth. I'm Melissa Francis. I know a little bit about this subject matter. I am former CNBC, MSNBC, Fox Business, and Fox News anchor. And joining us today is investor, legend, and founder of DoubleLine, Jeffrey Gundlach. Welcome. Thank you so much for joining us. I know on a day when we are watching markets tank, everyone wants to talk to you and get your perspective. I'm lucky enough to have you here, and I'm just going to let you go. What's your take on what's happening today?
Well, I think we need to start admitting that we're running into a stagflation situation. The Fed is in a really difficult position because these price spikes are really going to need the Fed to be aggressive if they're serious at all about fighting inflation. And we're starting at such a low rate level relative to inflation rate that's already 7.5%. You know, we have about a 1.7% 10-year treasury. We have Jimmy Carter type of negative interest rates. They're even more negative than Jimmy Carter. And then just to continue the metaphor, we obviously have skyrocketing crude oil prices. In the last 6 trading days, the price of West Texas Intermediate is up 35%. So when people are complaining about gasoline, they ain't seen nothing yet. There's some stations here in Southern California where the premium gas is $7.60 a gallon. And that was a $5.25 at those same gas stations like 6 weeks ago, and everybody was marveling at how high they were.
Can I jump in right there and ask you about that? Because, you know, I'm somebody who covered energy for 20 plus years, and I've seen these fluctuations before based on what we would always call geopolitical jitters. Are you sure that this is going to last? I mean, obviously right now, as we're looking at this standoff between Russia and Ukraine, everyone's panicking. But if there is a resolution, why wouldn't crude oil go back down? Not all the way. I understand that there's a lot of demand out there and that we've been stupid in this administration and that we haven't pumped as much oil as we should. But what makes you think it's really going to stay at this level?
I just kind of think the trend is your friend. We've been talking about temporary inflation in many, many items for 18 months now, and there just isn't any setbacks. You look at the Bloomberg Commodity Index, it's up over 100% in 18 months, and there's almost no correction. So I just think we have supply problems relative to demand. And until the cycle breaks, I just think you've got to go with the trend. And it seems to me that we're going to be seeing just further pressure for this year. I did a thing a year ago, and I went back and listened to it, and I was sort of shocked how quaint it was. I was talking with somebody about how inflation might go to 4% at the peak in the middle of 2021, and now it's basically double that. And I just sort of think that we're going to be constantly underestimating inflation because we have all of this stimulus that takes time to go through the system. I mean, an intelligent 12-year-old could tell you that if you gave thousands and thousands of dollars to families in America while simultaneously curtailing the supply of goods, that you're going to get inflation. And the thing about the financial markets and the macroeconomy is you can connect dots and think you see a picture of where things are going to develop to, but it takes forever for it to happen. It takes so much longer. The gears spin so much more slowly than people's patience wants them to, but inexorably they end up turning in that direction, and that's where we are. And now the problem we're having is I think that the recessionary risk is going up very substantially. When we look at sentiment, which is down very, very low in the most recent University of Michigan, driven mostly by cars and autos as being up so much. But then you've got the yield curve, which is flattening and flattening. And I like to look at the starting point, the spread between the 2-year Treasury yield and the 10-year Treasury yield. And once it gets inside of 25 basis points, you're on a recession watch. And there was a moment today where we're at 15 basis points. And then, so the other thing is that historically, oil shocks have led to demand destruction that causes recessions. And a number that is often referred to is if oil goes up by about 50%. Well, it's done that very substantially in just a few months. So I think that we're going to start hearing the word stagflation a lot more.
Hey, we already heard, I don't mean to interrupt you, but we already heard stagflation earlier today. We had Kyle Bass on. He said pretty much the same thing, but he had a different remedy for it. So he was thinking that the Fed was going to be forced to back off. He thought we might go into recession by the third quarter, and that might stop the Fed from tightening. But it sounds like you're saying, you're calling for almost a Volcker type Fed move, saying that, you know, the Fed, we're in a Carter period and the Fed's going to have to get really aggressive. Did I misunderstand you?
I think I'm just channeling Jay Powell when I make comments like that. He said something like that in his most recent testimony. He talked about how he's sort of praising Volcker because he understands that this situation is going to be inflationary, and they're going to have to fight inflation. For the Fed to have any credibility, they have got to raise interest rates. If the inflation rate goes to 8%, 9%, 10%, which I think is not implausible, I think the Fed has to raise interest rates. I think this Ukrainian war situation actually makes the Fed have to be more aggressive, because if they don't, then the Fed just doesn't have any purpose. So the situation that they're in right now is the most difficult that Jay Powell has seen, or any Fed chair, in a while, because the stock market is basically in a bear market. The NASDAQ is right about that 20% number. The S&P, is at the low of the year, and yet the inflation rate is going up. And the economy is likely to slow down with all of these price increases curtailing demand. So their number one goal is stable prices. At least that used to be the case. And then we talked about employment. Well, employment looks reasonable, so that's not going to stop them from raising interest rates. And then they've sort of secretly, stealthily, in the last 15 years or so, added that third mandate that's not spoken up in public, which is when the stock market goes down by X, and X seems to be 20 or 30%, we have a reaction, and the reaction is a pivot in Fed policy. But if we're going to have a recession, my fear is that we are going to see another round of this tool of stimulus and money printing. And we've been doing it now for quite some time, and every time we run into an economic problem, we do more of it. And the money printing that we did in the last 2 years to boost nominal GDP, the amount of debt that we took on just at the federal level is more than the increase in nominal GDP since the nadir of economic activity in the aftermath of the lockdowns. So one can sort of say that there is no economic growth. It's just government spending and government money printing, which is really going to lead us into a new phase of, I think, problems the next go-round of this stuff, where I think it's going to be a negative dollar trend. Just think of what commodity prices are doing in other currencies than the dollar. The dollar index is up at a local high. It's up at 99. A year ago, it was around 90, so it's up 10%. And we have these oil prices in dollars are at these huge numbers. And so just think of what the price pressure is for emerging market currencies that are weak, or even the euro, which has been very weak versus the dollar. So this is a global phenomenon. When you look at global inflation surprise indices, they're at levels never seen before. Every single region of the world has inflation data that is surprising to the upside. There isn't one that's surprising to the downside. So the Fed has to act on this. I respect Kyle Bass a lot, and I know that there are a number of intelligent people and analysts that say the Fed's going to back off, but I think the opposite is going to happen with this price spike needing some attention.
Okay, but it seems like one of the things that always gets in the way is politics. And obviously we have a midterm election. We're not going to have a lot of politicians in Washington that want to see stagflation, this recession go on, things get worse and worse economically. Don't you think they'll put pressure on the Fed to do something different? I know that's not supposed to be the way it works, but those of us who live in the real world think that potentially the Fed is influenced by politics. I mean, how does that play out?
It's possible. It might mean that they have to be more aggressive in the months ahead so that they can maybe not be so aggressive, say, late in the summer or early in the fall for the election. That could be the case. That's another variable that suggests a fairly aggressive Fed. I know that 50 basis points seems like it's off the table here in March 2022, but I think a 25 is just a guarantee. And I think there's going to be at least 4 hikes before, say, late this summer. So that's what's coming, and it's not enough. The inflation rate is so high compared to the interest rates that it's going to take some real action, I think. And one thing also, Melissa, is the long end hasn't had rates go up. In fact, long rates have been going down for the past year. I mean, they've had some volatility to them, but they're lower than they were. The 30-year Treasury is lower than where it was a year ago. So the Fed is being predicted by the bond market to completely flatten the curve. 1 year from now, the forward pricing of the bond market is that the 30-year Treasury yield will be where it is today, with the short rate going up to about 1.5%. So a flat yield curve at these yield levels sends a monstrous signal that the economy could be entering a period of fragility. With durable goods, obviously, sales were pulled way forward with appliances and autos and housing and all these things. So there's room for those things to slow down. And that's what we're looking at.
I guess one of the points I was trying to get at is that it's hard to imagine a Fed today that has the will of a Volcker. That, you mentioned the fact that whenever the stock market dips a certain amount, that they could go and get involved. It seems like we have been living in an era of a very protective Fed for decades now, where they're willing to act to, I don't know, sort of place a pillow wherever the economy may potentially fall. The idea that they're going to suddenly, have the come to Jesus moment and really battle stagflation. While I agree with you, it's necessary. It's hard for me to imagine them really having the will to do that. I mean, would you bet your money that they're going to get in there and really swing?
I think I'm already doing that. I mean, I have a very low risk position, and I have had for a while now, because I think everything was balanced on zero interest rates, and on top of that, quantitative easing that was running at $120 billion a month. And we've seen this movie before, where the 2-year Treasury yields goes on a little bit of a strike, and you see the Fed at zero, but the 2-year Treasury yield started to rise about a year ago, and the Fed just follows 2-year Treasury. I say somewhat facetiously, but not fully facetiously, that we could replace the 800 PhD economists with the Fed with the 2-year Treasury yield on a Bloomberg screen, because they just follow the 2-year Treasury. And so the 2-year Treasury went up, and so all of a sudden Powell had to go into a pivot. And so that's what happened. It's going to be dependent upon how the 2-year Treasury behaves. And it's possible that the bond market's message, I think it's even likely, is accurate. And they're going to be raising interest rates until a recession comes. And the message is that the recession is going to come at pretty low interest rate levels, which will lead to another bailout, if you will, of the economy with the only tool that they know, which is always higher deficit spending. So I really don't like dollar-based investments at this point, because the dollar is so high, and it's likely to stay high. As long as the yield curve flattens, it's very highly correlated to a higher dollar. And the yield curve's been flattening, the dollar's been going up. But when the next recession comes, I think the response, you say a pillow, that's a very gentle, nice way to say there's a pillow under the market. I kind of say that the authorities are drug pushers, and they're putting heroin into the economy all the time. And the doses keep getting bigger and bigger.
Yeah.
Maybe the next dose is going to be heroin laced with fentanyl. And it's possible that the dollar just can't stand it anymore and starts to decline. And I think that's how I'm positioning.
Let me turn you to what is potentially, or what was the cause of a lot of this in the first place, everything that's going on in Russia, in Ukraine, or at least was the near-term cause of why we're talking about all this. Do you have confidence in the Biden administration to deal with this properly, or get us out of this situation and, keeping in mind America's best interests?
They haven't done a good job so far. I mean, the report card on foreign affairs for the first year and a little bit of the Biden administration's pretty low. I mean, the Afghanistan thing, announcing in December that there would be no U.S. troops going into Ukraine is the reason why Russia invaded, I think. I mean, we basically said twice, in December and in January, that we'll support them, but we're not going to send in troops. And we should have supported them during the first quarter, the first couple of months of this year, with tremendous supplies of Stinger missiles and javelins and things, and we didn't do much of that. So I haven't seen an awful lot of strength out of the Biden administration, and in fact, there's just a lot of flip-flopping on a lot of issues. And I worry, like everybody else, that Taiwan may be in the balance here too. It depends how well or badly Russia does in Ukraine. I mean, they're doing badly enough that that's one of the good news items of the last couple of weeks, is the Russians are doing badly enough that maybe China is thinking twice about how easy it is to do these things. But I don't really believe that this thing is headed in a good direction. I think Russia is going to take over Ukraine. I think it's inevitable, unless we do the no-fly zone, which we're loath to do for very, very good reasons. I think that's the only thing that would stop Russia from succeeding ultimately in the takeover of Ukraine. Well, and so, no, I don't think the Biden administration is strong enough to meet the moment here.
Yeah, and in terms of meeting the moment, I mean, it looks like the Biden administration is going to have a recession on its hands as well. Almost everybody we spoke to today has agreed upon that. How do you think they handle and respond to that?
It'll be a huge stimulus package, same old thing. And it always has to be bigger. Back in the global financial crisis, it was a couple of trillion. This time it's 6 trillion. Next time it's going to be so big, and it's going to cause a really big dislocation because it causes inflation. And yet, when your only tool is a hammer, every problem looks like a nail, and that's become our MO. Back really in the response to the global financial crisis, and even before then, was this ridiculous deficit spending, and it's out of control. I keep telling people we have $165 trillion of unfunded liabilities in the United States, and those don't go out hundreds of years into the future. They go out a couple of generations. We have a $24 trillion nominal GDP economy, so the unfunded liabilities are nearly 7 times the annual size of the entire output of the GDP. So if we were actually going to try to fund these liabilities in a responsible way, it would take us 70 years nearly of putting aside 10% of our productive economy to fund these liabilities, which would mean that we'd be in a recession/depression for 2 or 3 generations. We don't have that tolerance. And so we're going to have to deal with these liabilities. And there's only 2 ways to deal with them. One is to restructure them, which I think will be part of the solution, and the other is to devalue them. That's it. You can't pay back $165 trillion of liabilities with a $24 trillion economy. It can't be done. So if something's impossible, it means it can't happen, and that's how I view this situation.
And of course, you're the bond king. So how do you position yourself in bonds to? I guess I mean, I don't want to say take advantage of all that because it's a bleak outlook, but to protect yourself through all of this.
Well, there is a case for a deflationary ultimate outcome here that could happen. And a deflationary outcome, you would want to own what most people view, including myself, on a valuation basis, looks like about the most unattractive thing out there, which is the 30-year U.S. Treasury bond. It sounds ridiculous. You would be advocating for something just over 2% against a 7.5% CPI that doesn't look like it's going to relax meaningfully anytime soon. But that is the one thing, that and cash, frankly, that can protect you from a deflationary scenario. So as weird as it sounds, I actually like cash in the bond market, short-term maturities. And I also think you're supposed to own some of, let's just say, TLT, the ETF. That can go under a certain way that this movie runs. It can go back down to 1%, which could give you some portfolio protection. Other than that, we've just like short maturities broadly. The credit market right now is getting very illiquid. The bond market broadly is getting less liquid, with the Fed not doing bond buying anymore after March this month. And basically, all this volatility that's in the economy right now and all the uncertainty geopolitically, we're starting to see, emerging market spreads relative to treasuries on an index basis. We're at about 350 basis points. They're now up at about 525. We're seeing junk bond spreads widening out pretty substantially. It's partly because of lack of demand at these low yield levels, but it's also because treasury yields have rallied in recent weeks on flight to quality basis. But these are also sending a reinforcing signal that's not yet a red alert, because the spreads haven't acted violently enough to say, oh, this looks like another classic prelude to recession. But there are many statistics, including these credit spreads, that are showing that way. So even bank loans are dropping in price, which had held up because they were floating rate. And so people were saying, well, if the Fed raises rates, at least this is an area where I get a higher income stream with the higher rates. But now it's just the uncertainty which is starting to plague. So right now everything's negative. Everything's negative except commodities. Commodities are up massively, and stocks just can't. A good day in stocks is flat all of a sudden.
Let me ask you to make some predictions, because I know you're the bond king, but your predictions in the past have been quite prescient. Let me start with President Trump. You were one of the first people to come out and say that he was going to win. How do you think the midterms are going to go? Who do you think the next president's going to be?
I don't think it's going to be Trump or Biden, the next president. I think the midterms are on track to be one of the biggest blowout disasters for the incumbent administration that we've had in my lifetime. The one under Obama was pretty bad in his midterm, but he managed to right the ship. But this one, these approval ratings are so bad. Now I know they've gotten a bump, kind of on a patriotism angle, with the invasion of Ukraine. But you mentioned earlier, Melissa, the inflation numbers that people are going to see at the grocery store and at the gas pump and in their heating bills I don't think people are aware of what's coming. And there's going to be a very negative reaction to it in the midterms, I believe. So
they aren't aware of what's coming. I hear people complaining every single day about what's already here. So if it's going to get even worse, that is really terrifying. You say that you don't think either Biden or Trump wins the next election. Can you expand on that?
Well, it's kind of far away, the next presidential election, but I've been of the opinion that as we move forward into this end game of our deficit-based economy, I think we will end up having another party that starts to materialize. And if you open your eyes, you can see there's already signs of that. You've got a Democratic Party, which is split in two. The Republican Party was basically split in two or three pieces, maybe, by Trump. So I think you might, if I want to make a bold prediction, and I don't put a massive probability on this, but I think it's higher than most people would acknowledge. I think that we might have in the next presidential election, maybe not an electoral college winner, that basically there's three candidates and they split it and it ends up being determined by Congress. I think that is a higher probability than at any time in memory.
Wow.
So I think that could happen. And given, who knows, maybe people will start to get along better, but there hasn't been much evidence of that. So that's what could happen. But I think the midterms are going to be a very big shift. And that's actually something to look forward to. I think if we could get away from this 50-50 situation, which has everybody hating each other and focusing on all the wrong things, rather than the fundamentals of our economy and the fundamentals of our political system, I think maybe there's a chance that we get a little bit better in that direction with the midterm. So that's something to be hopeful for.
Let me ask you about the stock market. Obviously got absolutely hammered today. You said on a good day, it's flat. What do you see happening in the next few months and year end?
I think we're getting pretty near a low, at least a short-term low. for the U.S. stock market because it's down so much. And when we get into these thrusts downward, I start following the VIX index really closely. And the VIX index shot higher, and it's up at that level, approaching 40, where it's usually the sign of a short-term sort of a bottom. So I think we're going to have a reflex rally in the stock market, and that could be coming. I think commodities should probably have some down days here. Stocks should probably have some up days, but I do think that we've topped out on at least the relative performance of the U.S. stock market versus other categories. I mean, strangely, with this war going on, until recently, until like Friday, a couple of trading days ago, emerging markets were substantially outperforming U.S. stocks, emerging market stocks. I think that's going to be a trend for some time to come. I recommend that investors dollar cost average out of U.S. stocks and into emerging market stocks just systematically. I don't think you should do a massive trade, a huge one-day asset allocation, but that I think is a way of resculpting portfolios that will take advantage of the trends that are underway looking forward, not a year, but looking forward about 5 years from now, when I think we're going to be talking about the dollar's reserve currency status waning, with the Chinese economy being basically the same size as the U.S. economy from a productive capacity. Their GDP is 75% nearly of U.S. GDP, but they have a lot of military spending. And, you know, what defines the U.S. reserve currency status? Well, it was the world's strongest economy by far, and we had the biggest military by far. And those are slipping away. And the reason, the fact that we've got so many unfunded liabilities and so much debt makes it very, very hard for us to stave off the challenge of our reserve currency status. Perhaps, who knows, by the renminbi. Certainly, they at least want a seat at that table.
Yeah. I know we're out of time. I can't let you go without asking you about, well, my favorite subject. Where do you think oil tops out?
I'm going to say $200 a barrel.
Really?
Yeah.
This year?
I think it's going to get there. Well, you got to remember, it's up 35% in a week, so it's on a tear, and we haven't even talked about the potential for an embargo, which there's sort of a de facto embargo going on. But if there was a real embargo, we basically have made a really bad misstep. We decided we hated a future with fossil fuel. But we acted on that hatred without a plan. We didn't have a plan to transition us from tremendous uses of fossil fuel into other sources of energy. And so we basically acted without a plan, and now we have this shortage. We're going to have to weirdly pivot back to more fossil fuel to ultimately get ourselves back on a path to the green fuels that everybody understands are a better long-term solution than polluting the planet so egregiously. But I think the
question I have about that, though, is whenever anybody talks about an embargo, do you think that we could have a real embargo, a true almost blockade? Because oil, as we all know, is fungible, and it seems like there's always a friend of Russia. There's always a bad actor somewhere that is willing to buy the oil that no one is supposed to, and it just shifts the rest of the oil to somewhere else around the globe. What are your thoughts on that?
I think that's true. I'm sure that's true. I hear a lot about how there's a lot of side door things going on already. But the thing is, if Western Europe and the United States and others decide that they're not going to buy from Russia, that is going to push up prices for the other producers. And Russia's already selling, I was told, at a $28 discount sometime last week. It may have even expanded, $28 discount to things like Brent and other sources. So that clearly is already happening. If you give enough of a discount, you'll get some takers. I think it's very telling, though, that we're talking to Venezuela and Iran, right, exploring with these bad actors about buying oil from them. I mean, that's acknowledgement that we are very low on attractive solutions, and what they don't want to do is encourage U.S. drilling again. They seem so committed to that policy, And that might be the ultimate outcome from the midterms, is that there'll be a message sent that people want action, not just empty words like, I'm going to work like the devil to bring gas prices down. That hasn't been working. So you better try something different.
Yeah, the idea that we would rather go down and make a deal with Venezuela rather than drilling here is really says a lot. And folks should remember that the next time they go to the booths.
It does not instill confidence. It does not instill confidence when your leaders are saying we're going to start making alliances with just horrible political animals instead of supporting our own resources and energy. It's very discouraging.
Yeah. Well, on that note, thank you so much for taking the time to talk to us today. I know everyone wanted to hear your thoughts on a day like this, and we really appreciate you coming here to Magnifi by Tiffin. Jeffrey Gundlach, thank you so much. And for more on anything that you heard here today, please go to magnifi.com/media. We'll be right back. Welcome back to Magnifi by Tiffin. Today we are talking about oil, China, inflation, the Fed, and the best strategy is to incorporate all of that into a portfolio to grow and preserve your wealth. Joining me now is Kevin Simpson, founder and CIO of Capital Wealth Planning, and Gary Kaminsky, former vice chairman at Morgan Stanley, former capital markets editor at CNBC. Gary is also an investor and a board member at Tiffin. Welcome to both of you. Let me start with you, Kevin. I don't know if you just heard Jeffrey Gundlach. He had a lot to say. Some of it was a little frightening. He was talking about the idea that we are heading into an era of stagflation, and he's not alone in that, but he does think that the Fed will continue to be very aggressive as that goes on. And even as we head into a recession, he thinks that they'll continue to raise rates and stay disciplined. Do you agree with that?
Well, I don't think they have much of a choice, Melissa, and it is an incredible thing to think about. I've been in this business for 30 years, and we're literally talking about the textbook stagflation. I mean, it's an odd combination, a contracting economy with rising rates. And can they do it successfully? Can they navigate us through that is a tremendous question. But to say that they have no choice isn't even up for debate. I mean, we have to begin to taper this inflationary pressure, and the only way for the Fed to do that is to begin raising rates. So to your point, it's a scary proposition, but I think it's probably the only rational choice at this point.
Boy, but that is just going to be such a tough pill to swallow. Gary, do you think that the Fed has the political will to follow through with that? I mean, I know that they are not supposed to be pushed around by what election is coming, but it's hard to ignore all of those factors, especially if you have folks trying to get reelected. Basically, do you think the Fed has the discipline to follow through?
Well, I think Jeffrey made an extremely important point, which was that what's going to happen after the Fed starts raising rates as they continue on this path that they've outlined, and we are in a recession. Once again, cutting rates is not going to solve for economic growth. So he more or less told you what started in the financial crisis with quantitative easing, and I can't even remember what we're up to. Maybe Kevin can, if we're up to QE 5 or 6 at this point when you take the stimulus programs necessary for COVID. He basically told you that we're going to create, once again, while we have not even gotten inflation down to the low levels that they want, we're going to be pumping more inflation into the system because we're going to be necessary to have further quantitative easing. To me, that was scarier than the idea that we're going into stagflation as it relates to owning assets and trying to figure out where to hide money, to grow it over the long term.
So, Kevin, if you believe all this, I mean, what is your strategy? How do you prepare for this?
Well, it's really a question of how do I keep pace with inflation? Because that's the one thing, that's the known entity we know is coming. We know prices are going to continue to be elevated for some time. It's not any longer a transitory issue. I mean, it is a straight up real issue. If they can begin to taper at some point, that's wonderful. And I think it probably can, considering we're starting from a complete economic shutdown. But the reality for investors is, how do we invest in an inflationary environment? What's the hedge against inflation? Could it be fixed income? Possibly. Certainly commodities here have been an incredible hedge, but that has a lot to do also with what's happening in Russia and the Ukraine. So for me and how I manage money, the one thing I can control is dividends. And it's not just investing in companies that pay dividends. More specifically, Melissa, we look for companies that are increasing their dividends over time. So you at least have a little bit of an inflationary hedge there from the standpoint of dividend growth. And I think that might be a real secret to the engine for the foreseeable future for people that are looking for an income stream, but really faced with this inflationary pressure.
But do they keep doing that if the economy contracts, though? That's the only thing. I mean, if we head into a recession, you say you look for them increasing dividends. Can they still do that if we're looking at a stalled economy?
Yeah, absolutely. The best companies can still make money even under inflationary pressures as long as they've got pricing power. But you have to be very, very careful because there are so many companies within the aristocrat world or the dividend king world that always raise a dividend. And to your point, they can't always afford to do it. There's very little chance that over the past 50 years, every single calendar year was so ideal that they could raise that dividend, but they just do it anyway. So I think you really need to identify companies that are increasing earnings, even if only marginally, to be able to increase dividends marginally as well. And maybe they're not going to increase a dividend each and every year, but you're looking for trends. And if we can see dividend growth somewhere between 10 to 15%, which is how we do it, we look back over a 5-year period. I mean, that gives you a fighting chance.
Yeah. Gary, go ahead.
Melissa, let me make a point here because Kevin and I have talked about this. You know, historically, academics like to talk about the annualized rate of the return of the stock market over the long term. And roughly, sometimes numbers get thrown out 9 or 10% annualized compounded over the very long term. What they very rarely say is at 60%, almost 2/3 of that return is not capital appreciation. It's not stocks going up in value. It's dividends and distributions reinvested. And so if we're in a stagflation environment, if we're in an inflation environment, investors really have to get a grasp on thinking, okay, as Kevin pointed out, my objective here is to grow the assets, but not to grow those assets necessarily at the historical rate of return of the stock market, but to keep my assets providing for me to keep up with inflation. And that's why some of those strategies that have worked, massive overweight in technology stocks, which historically don't pay high dividends, but they actually reinvest the capital back into the business. That's the changing of the guard, so to speak. And I think when we go back to the Gundlach interview, that was Jeffrey's point when it comes to equities, that we're in a different paradigm for what type of stocks to own for the next 5 years, especially if he's right about the Biden administration not being able to facilitate some sort of recovery here in the next couple of years after we go into a recession.
So Gary, I love that idea. I mean, that's brilliant. So what are some more plays like that? And Kevin, I would ask you the same thing. I mean, if this is the idea, if this is the era that we're going into, and you want to go with investments that are going to, you know, cleverly reinvest while we're all hunkering down and trying to get through this period, what are some other types of things you do? And I'm not just limiting it to stocks. Like, what would you do across the board?
Well, I'm an equity manager, so I'm only going to invest in stocks. But if I was an all cap manager, I mean, if I was an all encompassing portfolio manager, I'd still be very fearful of fixed income. You know, I know Jeffrey's talking about looking at the long end of the yield curve as a safe place to hide. And you know, he's far more brilliant at fixed income investing than I am. But I would be hesitant to be a retail investor really looking at fixed income as a means of an investment, because there's such a loss from the standpoint of the inflationary pressure when yields are so low, especially faced with what we know that rates are going to be going higher, that even if they want to get to their Fed fund rate of 2.75 and they just keep raising and raising and raising a quarter a point for the next year or two, that's still pretty much free money, and it still doesn't do a whole lot for a fixed income investor. It's a real challenge, especially for advisors and clients who are heading into retirement, because you know, we're sitting here talking about how do we generate income and how do we hedge against inflation. Well, the old way to do it is you invest in bonds. You know, in 2008, when we had a correction, one of our biggest holdings at the time, we did have an allocation to fixed income, and that 30-year treasury was up 25%. So it worked out really well. That's not going to be the case this time, certainly not for this recession. So if you're looking at across the board, I mean, cash is an investment, cash is an allocation, also a leader of a loss leader, because you're not making anything on it, but the power of that liquidity, I think, is important. And finally, you can use options. I mean, using hedging as a means of generating some cash flow and reducing volatility. buying long-term puts on the market, maybe writing some covered calls. I mean, these are all just, again, generic ideas that Gary can elaborate on others that can allow for a diversified portfolio to make sense and to be able to navigate through these stormy waters.
Kevin, what did you think of Gary's idea about investing in tech and specifically in companies that are big on reinvestment?
Well, I think it's to the benefit of the shareholder, whether you're receiving dividends or having share buybacks. We love it when a company can do both. But if you're looking at these high quality, really mega cap tech names that have massive share buybacks, Apple's a great example, Microsoft's another one. There's a dip here and it's an opportunity to start dollar cost averaging into those 100%.
So Gary, there was a massive amount of information to digest, overwhelming on a day like this. And now you have to do something with it. At least Magnifi makes that easier.
Well, I'll tell you, Melissa, what I was just thinking about was when I entered the business in the late 80s, if you wanted to hedge out in a stock portfolio interest rate risk, if you could, you either do it in the futures market, which many people did not want to do, or you had to go create your own structured product. What's beautiful today is that there are these ETFs that have been created, investment products that trade, they're very liquid, and you can buy interest rate hedging products if you have to protect your portfolio for stagflation and higher interest rates.
So for people who might be joining us for the first time, maybe aren't familiar with this, we're going to use Magnifi. It's like the Google for investing, although Google cannot do this, I want to remind you, but we put in that search bar that we want to invest in a situation where we're looking at higher interest rates, because that's, basically what all of our guests today agreed on as we talked about that. And let's bring up, once you put in the search, you get a lot of options to invest, and it's based on your choice of returns, risks, and fees. Let's pull up 3 of the top ETFs and mutual funds based on risk. And I'm seeing Pro Funds, Rising Rates, Opportunity 10 investor class, ProShares Ultra Short 7-10-year Treasury ETF, and Direction Monthly 7-10-year Treasury Bear 2X. And I believe that's a mutual fund. So Kevin, let me start with you. What's your reaction to those ideas?
Well, first of all, to Gary's point, to be able to pull that up in seconds is pretty impressive. And all 3 really serve the need of that inflationary hedge. I'd be leaning towards those shorter duration funds because, again, you're looking for liquidity to come back to you sooner. For traders, you can look at that 2X ETF. I think we have to distinguish the risk factor for a retail investor in something that's leveraged versus something that's not. And from a trading perspective, I think it could be a great hedge, but really making sure that there's that understanding of what it is that you own and making sure that in many cases, that's not a longer term investment, that's more of a trading vehicle.
So that's more for the pros right there. And it's for somebody who's going to be really active, who's going to stay on top of it. Gary, what do you think of those ideas?
Well, again, I think that it's got to be looked at an entire portfolio. But if you're an investor in Kevin's fund, for example, and he's detailed why it's important to think about the dividends and distributions, he's looking for companies that will grow their dividend. If you're an investor in his fund, he's not trying to protect you for higher interest rates. He's managing an equity portfolio. So when you look at your overall asset allocation, and if you don't have inflation protection, owning some products like this as a hedge, as an insurance product, is actually a great idea given the uncertainty we're all facing now for the next 12 to 18 months.
I mean, that is very cool because it's one thing to come up with the investment idea, the thesis, to look out at the world and try and figure out what you believe is going to happen, who you trust, who you don't, what you think is going to be coming down the road. And then the next part is trying to figure out, how do you actually invest based on that thesis? And Magnifi is helping us do that. I want to thank all of our guests today, Jeffrey Gundlach, Kevin Simpson, and Gary Kaminsky. Make sure you all visit magnifi.com/media to help identify the inflation plays to grow and preserve you and your clients' portfolios. I'm Melissa Francis. Thank you so much for being here.